Hello and welcome to the program. I am BC Adebayo. Let's start off with oil prices, which are up for a fourth time today due to expectations for rising fuel demand as the U.S. may expand their pandemic and payments, and a final Brexit deal is set to stabilize trade between Europe and the U.K. Brent crude futures climbed 0.5%, $51.13 a barrel in early trade, while U.S. WTI crude futures added 0.57% to $47.86 a barrel. Forecasts for tightening U.S. crude oil stocks also added support to prices. Meantime, an OPEC Plus meeting scheduled for January the 4th also looms over the market. OPEC Plus is tapering record oil output cuts made this year to support the markets. Now, the group is set to boost output by 500,000 barrels per day in January, and Russia supports another increase of the same amount in February. Back home now, the Federal Executive Council approved the 2.3 trillion naira Transit Nigeria Economic Sustainability Plan on June the 24th, 2020. That's in a frantic effort to respond to the challenges posed by the COVID-19 pandemic, create a financial stimulus package for the Nigerian economy, and create jobs for Nigerians, among many other benefits. Now, the NESP, which is developed as a 12-month plan between the Economic Recovery and Growth Plan and the successor plan to the ERGP, is already 6 months gone. But how much of an impact has the plan made in rebooting the Nigerian economy as we head to another fiscal year with multiple headwinds to tackle? Now, that's the basis of my first conversation this morning with the Managing Director, Cowry Asset Management Limited, Mr. Johnson Chukwu, who will also be talking about what to expect regarding the economy in the new year. Good morning, Mr. Chukwu. Thank you for joining us on the program. Now, the 2.3 trillion naira Nigeria Economic Sustainability Plan by the federal government is in its 6th month. How would you rate its performance so far?
Thank you, BC, for having me. Merry Christmas and Happy New Year. What I would say is that if you look at that economic sustainability plan, the larger part of it was actually driven by the monetary authorities. About 1.1 trillion of that is coming from the monetary authorities. You know, there's a 1 trillion naira for the industrial sector. There's 100 billion naira for the health and medical services. There's a 50 billion naira for small and medium-scale enterprises. So, but the key thing is that the component that is supposed to come from the fiscal authorities are still very, very weak. The most critical element of it is this, what they call the survival fund, which I know the government has started. It's actually meant to support companies that are in difficult situations that can't pay salaries of their workers. And from that economic sustainability fund, the government is supposed to help those companies to pay those salaries. But I'm not sure so many companies have benefited from that. The most component of that economic sustainability plan is a component that's coming from the monetary authorities.
Now, but when you look at the NESP now, which of course is serving as a bridge between the ERGP and the new plan, which is currently in development, is enough to rebase an economy suffering from stagflation?
Well, you know the key thing about winning the country out of economic recession, or what you call starvation, is it will require a lot. Beyond what the fiscal authorities and monetary authorities are doing, there's a large component will come from the private sector. There's also an element of it that are exogenous to us. That is coming from the external sector. When you made your introductory statement, you talked about oil prices and the agreement to likely increase the crude production. Last year, I mean, this outgoing year, most of the period Nigeria was producing legitimately 1.4 million barrels per day, which was quite far below our budgetary benchmark, or what we require to have a strong economy. So you have the exogenous factor which came about as a result of COVID-19. Hopefully, as the government is trying to address the issue of using the budget to reflate the economy, using expansionary monetary policies to inject liquidity into the system, there's also that critical element, which is the global economy must rebound. There must be demand for crude. Oil price must remain stable. Nigeria must earn enough foreign exchange to be able to lubricate the economy.
But in terms of stimulation now, would you actually say that this plan has achieved some level of desired results when you look at the fact that the the GDP numbers were in negative territory?
Well, it's too early to call. As you know, the GDP contracted. We actually entered into recession in the third quarter of this year. The contraction was 6.1% in the second quarter, and then we had a 3.6% contraction in the third quarter. We're hoping that by the end of the fourth quarter, the contraction will be slower, and hopefully by the second quarter of next year, we should come out of recession. But the key thing, like I said earlier, the fiscal component of the intervention engagement of the government has been very weak. We've seen monetary authorities going into overdrive, but monetary authorities not enough to bring a country out of recession. So what I would say is that we are still waiting for the full outcome of the government policies that are designed to bring the country out of economic recession. Unfortunately, which we must all have to accept, the government, prior to the COVID-19 induced economic crisis, our economy was already in a very precarious state. The economy was growing at a very slow rate, which we all say that any little thing could tip it into the negative, and that's what we saw. So we need to have a more robust economic growth, and hopefully by the time we come out of this economic recession, right policies will be put in place, which I'm happy that the government is beginning to put in place.
Well, yes, we all hope for a quick economic recovery, especially as we go into the new year. But let's not forget the second wave of the COVID-19 pandemic is already here upon us. So how are we supposed to go through this again with imminent lockdowns and shutdowns expected?
Well, BC, granted, in fact, if you look at even the numbers, the number of those infected under this second wave is far above those who were infected in the first wave. I wouldn't know whether it was because we have better testing facilities, more prevalent testing arrangements, or we actually have having more infection than we had the previous wave. But what we also have to recognize is that the world has found vaccines. We have the Pfizer vaccine, we have the Moderna vaccine, the other vaccines that are going through final testing phases. Countries are already buying up the vaccines. I think the federal government has budgeted about 40 billion naira for vaccination of Nigerians. Hopefully, we'll start with the most vulnerable. I want to believe that by the time we get to the second half of this year, the level of vaccination would have gone so high that people will begin to resume their normal economic activities. So I think the impact of COVID-19 will be more severe in 2020. By 2021, the world is going to have a hang on it. I don't think the global economy is going to go into a lockdown. If it will, given the rate of infection, we would have had a total lockdown. The world has accepted that we have to balance between livelihood and life, and that both of them are critical to survival. If you shut down the country like Nigeria, you are going to see possibly more fatalities as a result of hunger than you will have from the infection.
Yes, we are all, optimistic. Yes, there are vaccines and all of that. But then health is also very important. So what if, just what if, we have to get to that situation again where there is another lockdown? How do you expect us to come out of this? What do you think should be done? What lessons do you think we've learned from what happened in 2020?
Well, if, for instance, let's play the devil's advocate that we have to go into lockdown, the first thing the government has to do is to make sure we provide food. We need to provide food to the most vulnerable citizens. If you recall, it led to an upsurge in crime. People got to a point where they had to disobey the lockdown and enter the street to survive. So if for any reason we have to play the devil's advocate, like I said earlier, and we have to think of a possible lockdown, the first priority is that the government must develop a mechanism to reach out to the most vulnerable in terms of food provision. There were palliatives provided by COVID, which interestingly my company, Cowrie Asset, is member of. And unfortunately, that was not distributed on time to the extent that people had to go into those warehouses, to break into those houses to access those food. We shouldn't allow that to repeat itself. We must do like what other countries are doing, where they use technology to provide support to the citizens.
And that brings me to my next question now. The Vice President, who chairs the Economic Sustainability Committee, in a statement yesterday said that the COVID-19 stimulus package has so far reached about 1 million people, just like you mentioned, and there are plans to expand the scope. But do you think that such initiative should not be a one-off from government?
Well, interventions at periods of crisis is not an ongoing thing, but if you're talking of social safety nets, which I think your question is alluding to, that we must provide some support to the most vulnerable in the society. Many of us have advocated that. That has been the hallmark of Western countries where they have social capitalism or socialist economies, where the most vulnerable are taken care of, and then those who have the capacity are taxed to support the most vulnerable, still allowing for free enterprise. If you look at the population of Nigeria that are really in abject poverty, they are living under the poverty line. The World Poverty Clock said about 98 million Nigerians are living below the poverty line. So if you're talking about 1 million people who the government has been able to access to support, that's a drop in the ocean. So the key thing for me is that, one, we must have an economy that is a bit more robust, that has the capacity to provide employment, which is a core of supporting the citizens. The most critical challenge we have today is that the larger population of the young, able-bodied people cannot get jobs and therefore cannot fend for themselves, and they now fall into that poverty dragnet and now need support. We need to expand the economy. We need to create economic policies that will allow private enterprises to be successful and employ more people, and therefore will reduce the number of people the government will need to support.
But if you were to do an assessment now, would you say that since the pandemic, the federal government has developed a good number of pragmatic economic policies to actually lift the economy out of recession?
Well, there are some of them, and I think some of them were forced on the government by the exigencies of the current economic situation. And let me mention a few of them. The government has pulled back from subsidizing refined petroleum products, which many of us have cried ourselves hawks, saying that the government has no business subsidizing consumption, that if we have to subsidize anything, let's subsidize production. Today, the government is pulling back from that. The government is pushing, and a lot of multiple benefits that will come from the government pulling out of subsidizing petroleum products. You're going to have the refineries, you're going to have the petrochemical industries. They will produce resins, produce other byproducts for other industries, pharmaceutical industries, plastic industries to come up. So that's one thing. The other thing the government is doing, the government is considering bringing the private sector to invest in infrastructure. I cried myself out saying that the government does not have the economic resources to build infrastructure quickly so as to catapult this country into a developed society. So some of those things we are compelled on the government by the severe revenue debt, and the government had to start thinking beyond the idea of funding virtually every aspect of our social life from the budget allocations.
Now, let's talk about one of the recent government policies, talking about the cutting of non-essential spending, which, of course, has been a major talking point over the years. But it seems that that doesn't affect the budget so far. So with recurrent still consuming more than capital expenditure, is this a case of yet another policy somersault?
No, this is not a case of policy somersault. It will take some time for you to reverse the obtuse nature of our budgetary system, where recurrent expenditure trumps over capital expenditure. If you look at the current 2021 budget that has been passed by the National Assembly, recurrent expenditure about over 5 trillion naira, while capital expenditure just about 4 trillion naira. But just that does not even show the full picture. The full picture is that it's only when the government is able to meet its revenue projection that we have the way with that to spend on capital budgets. Because remember, the capital budget is discretionary in nature. But the recurrent expenditure is not discretionary. The government must pay salaries, must pay the overhead of the government, the president must move around. And these are elements that, for us to bring them down, the president has actually approved that the government should implement the civil voluntary report, which of all has not been implemented. We need to go to that level of drastic restructuring to reduce the recurrent expenditure. Otherwise, you're not going to see that reverse in a single year or two. What will happen is that either we go into a restructure of the fiscal framework and reduce the number of ministry agencies and departments, or we will grow the revenue to such an extent where it will get to a point where the government has the headroom to increase capital expenditure above recorded expenditure.
Now, when we talk about infrastructure deficit, it remains at its peak when you compare to growth. But how much growth do you think we've achieved so far this year?
In terms of infrastructure,
Absolutely.
well, there are a few things that, for instance, the Lagos Ibadan Express Road has started operation. And for me, that's one of the most critical infrastructure development we've had in the recent history, beyond the Abuja-Kaduna rail line. Because one of the things you need to do is some of the most strongest infrastructure deficits we have here are power infrastructure, which is electricity supply, and then transport infrastructure, which we talk about the rail system, the road transport system, and the water transport systems. We need to address those two critical infrastructural deficits. And if we have done the Lagos Express Road, one down, many more to go. So we will say we are making some nice achievements, though at a slow rate. Many of us are hungry for faster infrastructure development, but somehow we are making the right steps.
And talking about steps now, when you look at the major part of the loan from the World Bank, now it will be channeled to infrastructure development, but how much stimulation in terms of jobs and income can that provide in the near term?
Well, the good thing about infrastructure development, it has multifarious and multifaceted benefits to an economy. If we take, for instance, if the $1.5 billion coming from the World Bank goes into infrastructure, you are going to see, for instance, it goes into road infrastructure. They will buy chippings, they will buy cement. The cement company will employ more people to produce more cement. Those who are producing chippings will employ more people to produce more chippings. You're going to buy iron rods. Many of those things are being produced locally. You're going to employ laborers, blue-collar job workers who will be engaged on daily pay. And these people will earn income. They will go back to the market, buy goods from the woman who is selling tomato and the woman who is selling cassava, who will now go back and be motivated to produce more. So once you build infrastructure, like what the US did, they came out of the US depression of 1929 to 1933 from infrastructural spend, where the government built bridges, schools, and used that point to engage a lot of workers who got employed, who got income and went back to consumption. And then once you stimulate consumption, the engine of economic activities begin to rev.
Now, let's do a bit of forward-looking now. Of course, I know that we touched a bit on this earlier on, but what sort of recovery do you see for the economy going into 2021?
My projection that the economy will recover in second quarter of 2021. It will still be a slow growth. We've dealt with slow growth since the economy went into recession in 2016, when the economy contracted by 1.58%. Subsequently, in 2017, it grew by just 0.82%. 2018, it grew by 1.9%. 2019, we grew by about 2.2%. So I think we will still have to deal with slow economic growth in the next couple of years. We need to drive private sector investment. We need to drive foreign direct investment in the economy. We need to open several segments of the economy that are both potentials of strong growth for us to see the double-digit growth we saw in the 90s. That's what we need to grow. At a slow economic growth rate, we're still going to be dealing with increasing level of poverty because the population is growing about 3%. The economy must grow at above 3% to create jobs and to take people out of poverty.
What about the commencement of the AfCFTA on January the 1st?
Basically, for me, unfortunately, we are not prepared for the African Continental Free Trade Agreement. When I learned that the headquarters of African Continental Free Trade Agreement is going to be settled in Ghana, I almost wept. The reason is that Ghana population is just barely slightly above Lagos population. Ghanaian economy is just slightly above Lagos. I'm not even sure it's bigger than Lagos and Ogun State economies combined. But African Continental Free Trade Agreement is going to set up there. Ghana has turned, Kotoko Airport has turned to an African aviation hub or West African aviation hub instead of Lagos. So we have not built infrastructure to support investment into Nigeria. A lot more companies are going to Ghana to set up operational activities. People will come as close as Benin Republic or Togo to set up operational activities. targeting the Nigerian market because the Nigerian market is still the largest market in West Africa. But we do not have infrastructure support. We do not have the appropriate policies. Only recently we have opened our borders. That would be a red flag for any foreign portfolio investor, sorry, any foreign investor wants to set up in Nigeria, because if you can close your border for more than a year, then that sends an alarm bell to anybody who wants to set up in Nigeria to service other African countries. So I don't think we are fully prepared. I hope that we will be jarred into wakefulness by the fact that we are seeing companies go to neighboring countries as small as the smallest state in the country to set up operational activities, because their target is Nigeria, and we don't have the infrastructure, nor do we have the policy environment to support Nigeria as a productive base for companies to set up in this country and sell to other African countries.
All right, but in spite of all of this, we just keep staying positive. I'd like to appreciate you, Managing Director, Carry Asset Management Limited, Mr. Johnson Chukwu. Thank you for speaking with us, and do have yourself a wonderful holiday.
Thank you.
We'll be talking commodities when we return in just a moment. Do join us again. A research analyst at the financial derivatives company Desola Somoni joins us now to take us through the latest burning economic issues at the domestic commodities market. Good morning, Desola. It's good to see you again. Now you're back home. But let's start our conversation with oil prices. Of course, we've seen them remain flat despite bullish sentiments from the U.S. COVID-19 stimulus package. But why are we seeing this? And give us your outlook for prices going forward.
Good morning, BC. Thank you for having me on the show. So like you said, we've seen oil prices rallied briefly after the U.S. President Donald Trump has signed the $2.3 trillion stimulus package. However, we are also seeing that due to rising coronavirus cases across the world, particularly in Europe and in some countries in Africa, we are also seeing the new strain. Those factors are weighing on oil demand. On the supply side, we're also seeing that, OPEC is set to increase production by around 500,000 barrels per day from January. And Russia, one of the largest non-OPEC producers, has signaled their intentions to support a further increase in production in February by under 500,000 barrels per day. So these are the factors weighing on oil price, and that is why the bullish sentiment or the bullish rally from the stimulus was short-lived. So overall, towards the end of the year, we expect the market to remain a little bit quiet because of traders are only just concerned about closing their books for the year. But I think that the rising coronavirus cases, particularly with the new strain and the attendance restrictions and travel bans, I think that will weigh on prices in the near term.
Well, let's talk about gold now, which is usually viewed as a safe haven during times of crisis. As a result, now we're seeing gold having a bullish run this year, increasing by around 27% yet to date. Similarly, we've seen gold exports in Tanzania, which is one of the largest producers in Africa, increase by about 36% year on year in November. So talk us through all of these developments.
Like you said, BC Gold has had a very, very terrific year due to the coronavirus pandemic. Like you also said, gold is a safe haven asset, and when in times of uncertainty like we had this year, gold actually increases. This year, we've seen gold increase to record highs, and like you said, it has increased by around 27%, 28% year on average this year. But right now, we are seeing this, the U.S. stimulus package that was signed was also positive for gold because it also brought about a risk-on sentiment, which dampened, which led to a weaker U.S. dollar against a basket of other currencies, and that boosted gold prices. So overall, I think going forward, some analysts forecast that next year gold will rise as high as $2,000 per ounce, and that is going to be driven by rising inflation expectations in the U.S. It's going to be driven by lower yields on U.S. government securities, as well as the weaker U.S. dollars.
Now, let's talk about Nigeria's port crisis. Now, recently, the Financial Times reported that it cost around $4,000 to truck a contained 20 kilometers to the Nigerian mainland these days, which is almost as much as it costs to actually ship a container from China. What are your thoughts on these developments?
I think the key word is the congestion at the ports, and it's not a new phenomenon. I've been talking about this congestion at the Lagos ports in particular for ages, and we know why we are having this congestion. One is the aging infrastructure and limited capacity. For example, the capacity at the Apapa and Tinkan ports have remained the same since around 1997. Meanwhile, the population in Lagos has more than tripled. Also, because of the lack or inadequate rail infrastructure, most of the cargoes are transported via the roads, which is increasing pressure on the roads. That is part of why you see those long queues on the roads, amongst many other factors. But this has been worsened by, one, the border closure, the closure of the land border, which has now led to a lot of traffic from the land border to the sea borders. Two, the coronavirus pandemic, which has disrupted and crippled supply chains and trade globally. And three, the what's the word now? The unrest that we saw in Lagos a couple of months ago also led to increased congestion at the ports, and the implications of this are very big. Some analysts have estimated that every day that the truck or that every day of congestion at the ports is costing Nigeria around $55 million in terms of lost economic activities, also leading to production delays, particularly for multinationals which depend on imported goods for their production. And this is also translated into the cost of production, which is why our inflation is really high these days. So those are the factors that are responsible. And I think that the government have been making some progress in trying to ease the pressure at the ports, but I think it's not enough. It's not enough. More needs to be done to increase that. And we are seeing some progress also with some public-private partnership. But I think that more needs to be done to ease the congestion at those ports.
But now that the borders have been reopened, I mean, some of the borders have been reopened, how much of help will that be?
I mean, it will help just a little bit because of most of these cargo coming from the seaports are not coming from neighboring countries. Really, they're coming from high seas, they're coming from China, they're coming from Europe, and the land borders would only help with intra-Africa trade. But also we've seen a lot of traffic because of the close of the land border. I've seen a lot of traffic go to regional ports that are more efficient. For instance, the port in Lome, Togo is now, which is very small compared to Nigeria, is now one of the busiest ports as a result of the inefficiencies in the Lagos ports.
All right, Desola, let's talk about the price of cement. Now, the price of a 50 kg bag is up by around 36% in December compared to what we had in November. What are the drivers of this spike in the price, and what are the implications for the construction sector?
Let me start by saying, typically in the dry season, we see huge demand for cement because of a lot of construction activities go on during the dry season. And the dry season, we know for Nigeria, the dry season is from October to around April. So we are in the dry season, and that's one of the reasons why we're seeing big demand for cement. Also, we are seeing some production issues in some of the big players in the cement industry, which is affecting the availability of cement. Secondly, we are seeing some logistics and distribution issues. Cement Truck Driver Association that I think they're protesting or they're on strike for improved welfare. We are also seeing that because of what happened, I think in Lagos, the security issue, we are seeing some distribution, so a breakdown in distribution really. Finally, we are also seeing these cement dealers exporting to neighboring countries because of it, they get more bang for their buck than in the domestic country. And that is why we are seeing a lot of cement scarcity, essentially, and that is why the prices has increased sharply this month. Also, so what are the implications of that? The implications of that would be, one, and in the context of lower fresh real income because of higher inflation, I think we'll see fewer construction projects, and some projects that already begun may be stalled until the price situation becomes a little better. And overall, I think we're going to see lackluster activity in the construction sector this year compared to previous years.
All right, now let's switch gear to the Forex market. Now, of course, the exchange rate at the parallel market has remained flat at 465 to the dollar. Meanwhile, the level of external reserves have also increased marginally to $35.91 billion. Well, what's your outlook for the exchange rates going forward?
I think the outlook for the exchange rate in the near term is positive. I think the Naira would appreciate at the parallel market for a variety of reasons. One is the World Bank $1.5 billion loan, which is going to boost the external reserves. Already, we've seen the external reserves starting to increase, currently at $34.91 billion. We are also seeing this new exchange rate policy, this new remittance policy, whereby if I send remittance to my folks back home, they receive the dollar. Was the situation before. We're also seeing relatively better oil prices. Oil prices currently around like $51 per barrel. We are seeing Nigeria's production also increase. The rig count as of last week was up by 8, which signals that more oil is going to come online. So overall, that means that we are going to have, some higher oil receipts. So overall, I think these factors in the near term are positive for our exchange rate. I think the exchange rate is going to appreciate in the near term.
Now, the latest data from the CBN shows that manufacturing PMI stood at 49.6 points in December compared to what we had in November at 51.1. What are the implications of this for the manufacturing sector and the economy in general?
Like we know, the PMI is a leading economic indicator, which shows it gives a sense of the health of the manufacturing sector and the economy as a whole. So a PMI figure of 49.6 shows manufacturing sector is contracting compared to the figure in November, which was 51.1. Then it was expanding, and compared to October, which was around 49 also. So overall, I think that the sector is contracting, at least in December. If you look at the subsectors that were surveyed, out of 14 sectors that were surveyed, 4 sectors posted expansion, meanwhile 9 sectors posted a contraction. Now, when we look at the further breakdown of the indices, we see increases in certain indices, such as production was up, new orders was up, supplier delivery time was up, but other indices such as employment was down, and raw material inventory was down. Overall, I think it shows, taking the PMI figures for October, November, and December together, I think it shows that the GDP figures for Q4 will be slightly better than it was in Q3. So we may see a very, very weak positive number, or we see a smaller contraction in GDP numbers for Q4.
All right, Desola, it's still the festive period, but talk us through the latest developments in the domestic commodities markets, and where do you see prices going forward?
So compared to last month, I think the situation in domestic commodities markets is better. We are seeing prices reduce. Prices of some commodities are reduced. We are seeing, let me say, it's a mixed bag. It's a mixed bag of positive and negatives. So we are seeing prices of rice. Price of rice is down, I think, by 6.5% from 30,000 naira last month to 29,000 naira this month per 50 kg bag. We are seeing price of gari also down 15% from around down 15% from last month to around 12,300 naira for a 50 kg bag. That's for yellow gari. We're also seeing 50 kg basket of onions down around 6.3% from 80,000 naira last month to around 75,000 naira this month. So that is positive. Other commodities, we are seeing them flat. We are seeing palm oil flat at 15,000 naira for a 25 liter gallon. We are for 25 liters. We are seeing the price of new yam also flat at 1,000 naira for medium size of new yam. We are seeing the price of sugar flat at 19,000 naira for a 50 kg bag. And we are seeing 50 kg basket of tomatoes also flat at 15,000 naira. But on the negative side, we are seeing some price increases. For instance, we've spoken about cement. Cement has jumped significantly, 36% to 3,600 per 50 kg bag. We are seeing the price of flour also increase by 3.7% to around 14,000 naira. So overall, I think first the reopening of the land borders is positive in the sense that more supply would come into the market. So I think that should help reduce domestic commodity prices in the near term. But also we saw during this festive period that demand was quite low because of squeezed incomes. I mean, we know what happened throughout the year. So demand was quite low because of squeezed incomes. So that is also affecting domestic commodities prices. domestic commodity prices. And finally, with rising coronavirus cases and more and more restrictions, I think that is also going to weigh on our domestic commodity prices in the near term.
All right, Desola, we'll have to wrap up the conversation at this point, but thank you and do enjoy the rest of your day. And shall I wish you a happy new year in advance?
Thank you, you too.
Desola Sumoni is a research analyst at the FDC. We'll be right back in just a moment. Please stay with us. It's time to bring in Juliana Olayinka to bring us up to speed with the latest in the UK, especially as we count down to Brexit. Good morning, Juliana. It's countdown to Brexit in just a few days. How are you guys hoping to go through these moments without much difficulty?
Good morning, Bissy. Well, there will be difficulty. Michael Gove, all of the other ministers who should actually be on their Christmas holidays but have been called back because of this last-minute Brexit deal. They have been telling people to get ready for some bumpy moments over the next couple of months. And these bumpy moments are really just procedures. I think the government have quite clearly been solely focusing on making sure that £300 billion a year of trade between the UK and the EU is going to be tax-free, is going to be tariff-free, and they've managed to secure that. But it's the small details within that 1,225-page text that is going to come back to haunt some businesses and some consumers. I think with consumers, really, it's how you're going to be travelling within the EU over the next 12 months and beyond. Brexit has been going on for about 4.5 years now, but in the next couple of days, in fact, 3 days, things are going to change. I think most specifically, it's going to be about mobile phone charges. Typically, if you're travelling within the EU and you live in the UK or you have a UK mobile phone provider, you can just make phone calls and texts and use your internet as you would if you were within the Isles. That isn't going to be the case. Every different mobile operator will have separate charges. So people are being asked to make sure they check with their mobile phone service provider before they travel after the 1st of January. And also another main sticking point is health insurance. There was an umbrella underneath the European health insurance card. That's now scrapped. So if you do fall ill within the EU, or if you're in the EU and you fall ill within the UK, there will be separate charges that apply. And then, of course, for small businesses, even though there are not going to be these tariffs on imports and exports, the Federation of Small Businesses have been speaking to the media, really urging both sides, both in Brussels and London, to provide a grace period for customs declarations form. I think that's really going to be the key sticking point. Many of these businesses have, of course, never used one of these customs declarations form. This is part of the bureaucracy and red tape that is going to be forming over the next couple of months. And again, because it's taken such a long time and we are literally at, well, we're past the 11th hour, aren't we now? And nobody is able to really go into that document with full scrutiny. And so there are going to be small things that prop up over the next couple of days. But what has been asked is for a grace period so people can get used to this transition once and for all.
And then, how's everyone reacting to news that holiday makers or online shoppers who buy items from the EU valued at more than £390 will have to pay customs duties?
Again, unfortunately, Bissy, for the layman, for people like me and millions of others, nobody's been looking at the small print. We've really been relying on the government, and all they've been asking people to do is to get ready. But to get ready for what is the key question. And I think tomorrow, once, lawmakers in Britain are going to be seated in the House of Commons, hopefully more detail will come out of that, because as of yet, this Brexit bill hasn't been published. So we are relying on different drips and drabs that are coming out from Westminster and Downing Street. But I think one of the most obvious or the most consumer-hitting reaction from this Brexit deal will be about this import and exports. So if you are posting something to somebody within the EU in the post office, there are now going to be separate forms that you will have to fill out. If it is above a certain amount of money, not only are you going to be paying customs duty, there is also going to be a value-added tax and other payments that you will have to pay on top of that. Also, as well, we know many people in Britain do love booze, as they call it, a lot of French wine. Typically, you could go into a store in Calais or in Paris and you can buy as much wine and champagne as you like. That's not going to be the case anymore. There is going to be a limit on how much you can purchase. But again, this deal was just struck on Christmas Eve, so the details and the analysis and the scrutiny hasn't yet come. The headline for Boris Johnson's Conservative government and the EU is that they have signed a free trade deal. The detail, as people would say, which is where the devil is going to be sitting, will not start coming out until the next couple of months.
So we just have to wait patiently to have those details. But now, let's talk about this research by data provider Dearoom, saying that UK technology companies attracted a record £11.2 billion in venture capital funding in 2020. What are the facts behind the figures, Juliana?
Well, this is an absolutely amazing story. It's £11.2 billion, but it's actually worth £15 billion, and it actually exceeds the £14.8 billion that was invested. £14.8 billion that was invested into these tech companies in 2019. So many different tech companies, as we know, as we've discussed, have been doing exceptionally well during the pandemic. As many companies have fallen over, tech companies have really surged. And Britain, believe it or not, has become the cream of the crop in Europe. And that 15 billion worth of investment is more than the combined total of investment into Europe tech companies. Some of them we've discussed on the show. I believe last week we were talking about Octopus Energy, a relatively new energy firm. They got $200 million worth of investment from Tokyo Gas last week. Challenger Bank Revolut, also digital insurer Key, they both raised $500 million. This is an absolutely exceptional story for Britain, especially, they've suffered so much during the pandemic. One of the worst affected G7, G8, G20 countries when it comes to the contraction of their GDP. And we've actually got a little bit of a quote from the digital minister, Caroline Dinenage. She says, despite the challenges of 2020, the UK tech sector has once again proven the strongest, creating 7 new billion-dollar companies. These are unicorn firms, and achieving record levels of investment. So even though it's not been a fantastic year for these billion-dollar companies, it's been absolutely fantastic and really proves that Britain is one of the investment capitals of the world.
And we indeed love good news. I mean, it's a good way to actually wrap up the year. Thank you, Juliana. We'll see you again in the afternoon.
Thank you.
All right, let's get back to Eddie for the rest of the markets. Over to you.
Thank you, BC. Well, the unlisted securities market closed positive last week. It was up 0.91% at 729.41 points, while the market cap was at 523.37 billion naira. Now, last week, there were about 3.11 million units worth 33 billion naira traded in 14 deals. Now, just to, look at the fixed income markets, let's talk to Ramat Baba, the chief dealer of fixed income at FBN Quest Merchant Bank. Good morning, Ramat. Compliment of the season.
Good morning. Compliment.
Well, as the year winds down, I'd just like to get your expectations from the market. I mean, we have just 3 trading days to the end of 2020. What are you expecting from the fixed income market? I'm looking at the bonds and treasury bills market.
Coming from last week, we've seen yields trending north, mainly on bonds. There's been some selling interest, probably due to profit taken by a few counterparties. But of course, we still have a few buyers in the market who seem to think the levels are attractive, and there's been some picking, though this has been a bit strategic. So of course, the selling has clearly overtaken the buying. So we've seen yields going up slightly, and this has been the trend continuously in the last 1 week. Into this week, we expect that to continue at least till the end of the year. There might be a bit of moderation at the start of next year, which should be next week, Monday. We expect markets to probably ease out to moderate a bit because, of course, the year would have been over, profit taking should be over, and then we should see people building up strategies into the new year. For Treasury bills as well, we've seen market has been a bit low. We've seen more activities around the 4th of March bill, that's the special OMO bill given to banks by the CBN for CRR. We've seen some demand on those under maturity. They're actually trading slightly higher than where they were issued.
All right, Ramat, thank you for your input on the program. And should I say Happy New Year? Because I wouldn't be talking to you until 2021.
New Year. Yes.
Ramat Baba is the Chief Dealer of Fixed Income at FBN Quest Merchant Bank. Well, that's it on the market for today, BC.
All right, Eddie Young, thank you. We keep our fingers crossed and see where the markets will go for the rest of the year. And that's it on the show today. Thank you for watching. I am BC Adebayo.